Hello everyone, this week we have a simple setup on the USDJPY chart that caught my attention and I thought I should share it with you. Price has spent the last week caught between two important levels, and with major economic data from both economies coming up, this range that I have identified could give us a useful guide for the new week. So in this video, we shall focus mainly on the 4 hours time frame, and let's see what price is telling us at the moment. Now, the first thing that stands out here is this very strong bearish move that started on the final trading day of July and continued into the beginning of August. USDJPY had pushed close to the 164 area, as we can see here, before intervention strengthened the yen and pushed price sharply back towards the 155 area. But notice what happened after price tested around the 155.25. The selling pressure began to thin out and buyers gradually started producing higher lows. And when we connect the series of higher lows, it gives us this ascending trend line, which obviously captures the recovery we have seen since the intervention-driven sell-off happened. And this recovery also tells us something important. The intervention strengthened the yen, but the wider pressure on the currency did not completely disappear. The interest rate gap between Japan and the US is still significant, which continues to make holding the dollar attractive relative to the yen. Now, look at what price had been doing over the past week. We can see the price has been confined between approximately 158.75 and 159.5. And this range-bound structure shows us the level of indecision currently in the market. As we can see, buyers are still protecting the recovery from 155.25, but they have repeatedly struggled to extend beyond 159.5. As we can see, every attempt by buyers to break out of that structure has always been met with a resistance from sellers. At the same time, sellers have also failed to produce a clean breakdown below 158.75. This makes 158.75 my key level going into the new week. The reason is quite simple, because it forms the lower boundary of the current range and it also sits very close to the ascending trend line that has supported the recovery. So we have a useful confluence here, and this is where the anticipation of the coming economic data becomes important. Market participants will be assessing Japanese growth data on Monday, the Fed minutes on Wednesday, and Japan's inflation figures on Friday. They do not necessarily have to wait for the actual releases before taking positions. Expectations around these numbers can begin influencing price from the start of the week, and this confluence around 158.75 gives us a useful area to observe how that positioning is developing. Stronger Japanese growth or inflation could increase expectations of another Bank of Japan rate increase and support the yen. On the other hand, if US rate expectations remain strong while Japanese data disappoints, dollar buyers may continue defending this recovery. So rather than trying to predict those numbers, let us allow the range to guide us here. A breakdown and retest below 158.75 together with a breakdown of the ascending trend line will tell us that the recovery from 155.25 is losing strength. That could give the yen room to regain control and bring lower levels back into focus. But if buyers produce a breakout retest above 159.5, that will show that the recovery is becoming stronger and could return attention towards the 160-164 area. And one thing we should keep in mind is that as price approaches 160, intervention risk may become more relevant again. Japanese officials and policymakers have continued to warn that further intervention remains possible if yen weakness becomes excessive. So for the coming week, the setup remains very simple. 158.75 key level, while 159.5 remains the resistance that buyers need to overcome. Let's see how the week unfolds. Until we meet again, trade safely, manage your risk, and I'll see you again next week.